All right, everyone. I have 1 o'clock p.m. So I'm going to go ahead and get started with this session. As you can see from my intro slide, my name is Bryon Parman. I'm the State Ag Finance Specialist for North Dakota. I work in crops and livestock, doing farm management kind of stuff, farm financial projections, overall ag micro and macro kind of analyses, and a lot of presentations on those topics. And I've been with North Dakota State now, I guess, about 2.5 years. I started at Mississippi State University Extension and came up here in spring of 2018. PhD from Kansas State University, originally from Nebraska. My family farms there in southwestern Nebraska. So ag econ is just sort of a natural topic for me to be working in. And here's my contact information for anyone who wants any further information or something else. I do a lot with land values and cash rents, which will be part of this presentation. And kind of what I'm going to cover or intend to cover through this is a little bit of what it looked like during the Q2 of the pandemic hitting, what the ag economy has looked like the few years prior to this, which haven't been all that great. Then kind of where we're at this last quarter, heading into the third quarter and then into the fourth quarter, and then an outlook for what we're kind of thinking is going to happen for 2021. And the truth is, anything that we say about 2020 is truly a projection, actually, simply because we won't know what 2020's numbers look like until at the very soonest spring of next year, as farmers market their crops from 2020 well into the subsequent years. Same with our cow-calf producers. Any backgrounding or feeding that they do, we're not going to know the consequences of those decisions well into 2021. So with that, I'll go ahead and get started. And I just want to kind of show this as a benchmark. So GDP by state, if we look at 2012 in North Dakota, we had almost a GDP in ag of, and this is how the USDA defines it, this agriculture, forestry, fishing, and hunting 2012, almost $5 billion was the GDP of North Dakota's ag in 2012. Now, that's one of the best years, maybe the best year we ever had. So I'm using that as a benchmark, sort of the high water mark for ag in North Dakota. But 2012 was an outstanding year, 5 billion, and sort of in the upper crust of ag production. Then last year, 2019, a little bit more than half of what we were able to do in 2012 at 2.7 billion. And 2018 was not a whole lot better. 2019, though, was a particularly tough year for us. We had weather issues as well as low crop prices because of the trade dispute. And we were one of the hardest hit states, as Dr. Olson can explain later in his talks, and on anything dealing with China or Asia in general, because we're the direct link to the selling to those countries. And when you impact that, you impact North Dakota more so than states that are able to export out of the Gulf of Mexico. So you can see that we really took a hit compared to our best year of around $2.7 billion in 2019, a pretty significant drop. And the years prior to that, 18, 17, weren't a whole lot better, or 16 for that matter. So we've really had just 4 tough years in this region as far as cash flows, productivity, and not necessarily productivity. We've been raising the crops. It's just they haven't been worth enough to us. So the Minneapolis Federal Reserve, which is our district, they do a survey, and this came from Q2. So Q2 was a pretty bleak outlook at the time that this survey was done and that the results were given. And so the key to the results of this survey is the word decreased levels. So you look at North Dakota here, I've got it bolded, and 90% of folks surveyed, which mostly are lenders for this survey, expected a big decrease in net farm income. 60% expected a decrease in farm household spending. A big one here, 80% decrease in farm capital spending. That would include equipment and replacing equipment, planters, combines, tractors. Going to hold on to them longer and not trade them off as quickly. Obviously, that's going to have an impact on our dealers and folks around the state who are in that business. And that was the expectation in Q2, and then a decrease in loan demand, probably because there just wasn't going to be enough funds, or there weren't going to be very many people looking to take on loans. So then the next question is increase levels for the past 3 months. Have you seen increase levels? Loan renewals or extensions? Well, probably a big increase in extensions. And North Dakota, there 60% saw an increase. Our state, compared to the others, were the ones with the highest increase level in renewals or extensions. Not enough data for referrals, so that's why you see a line there. Amount of collateral required increase, not really. And then 35% seeing an increase in loan demand over the last 3 months. So again, not a lot of loan demand in Q2, probably because folks were pretty nervous about taking on additional debt. And then this is for the next 3 months. So this was Q2 and the expectations of the lenders heading into the next 3 months. And I just want to say lenders are a good group to actually survey, because when you think about it, a lender is going to have a portfolio or a file of several producers in it. So when you ask a lender some of these questions, it's really kind of like averaging across maybe 10 or 15 or 20 different farmers all at once, because they wind up handling their loans and have a pretty good idea of what their financial outlook looks like, rather than having to survey farmer by farmer by farmer and then asking the question, will you actually get honest answers? Not that anyone's lying, just that how well do they know their own books? The lenders tend to know them pretty well because that's their business. So they expected 45% expected a decreased rate in loan repayments. That's pretty significant. Decrease in net farm income, that was the expectation. That Q3 and Q4 were not going to look good, at least Q3. Farm household spending, farm capital spending decreased, and then that continued decrease in loan demand. Now, again, these were expectations. This isn't so the last survey was what happened. This was the expectation for Q3 by the lenders across. So fairly bleak outlook. I mean, you look across the states, net farm income decrease. Only Wisconsin had less than 50% expecting that. And then increase levels. Really nothing here for referrals or amount of collateral required. Increased level of loan demand, less than 50% only in Montana. Above that, loan renewals or extensions, only about 35% expected an increase there. Again, that was asked in Q2 about Q3 and headed in moving forward. So similar but different. The Purdue University, in conjunction with the CME group out of Chicago, they do what's called an ag barometer, and it's really a survey of ag business professionals, farmers, anyone in and around ag, and kind of their sentiment on how things are going in the ag economy. It's kind of like, you could think of it kind of like the consumer index, that the University of Michigan's always showing, consumer confidence. Think of this as the ag producer confidence index, if you like. And right here, you can see this is when the pandemic started. Obviously, a huge drop in index of current conditions, and then expectations for the future, which is the blue line. Big drop, but look at where it is now. Actually, a lot of optimism out there, all things considered. And it shouldn't be a surprise because of the fact that we've had a pretty nice commodity price rally that Dr. Olson will go into much more in detail. And then we've also had these CFAP payments this year. And I'm gonna cover some of that here later on in this presentation. But you combine those two things, and all of a sudden, expectations increased remarkably. And farmers are generally an optimistic bunch, or they want to be optimistic. So if you give them any reason, if you give those of us who work in ag any reason for optimism, we will absolutely take it. And this is what is being shown right here, is this big increase in optimism. Now, I'm going to go into it in more detail, but what does optimism create? What does it breed? Well, more capital expenditures, willing to rent ground or buy new ground. If you have the cash to do it, you're more optimistic about the future. You're going to do those things. You're going to perhaps increase household purchases and domestic and spending within the household, those kind of things, which helps the economy, helps in sales tax in the state, helps just all around, helps the community, the businesses within the community, so that we're not just hoarding cash. So that's not insignificant. That's a pretty big deal. And then this one is talking about similar, the ag barometer here, and you see the big increase after the big dip. So not hitting the high, but actually, so this is just sort of the combination of the two, expected and as well as actual, and a big increase there in the last few months. And I would suspect that it's increased quite a bit more since. Now, about that farm capital investment, which I was just talking about, and you see, way down here, the lowest it had been in over 5 years. And now all of a sudden, with the fall of 2020 being as positive as it has been, combination of both rounds of the CFAP, as well as the big rally in livestock, as well as crop prices, and boom, you got this farm capital investment index increasing as people feel better about the future. They're able to price their crops for a lot more money. Now we're talking about perhaps spending more money on equipment replacements, or replacing grain bins or building grain bins, things like that. So now I want to talk about production costs, sort of where we've been on production costs and where we're going. And production costs are obviously pretty important, because as I talk to farmers and I give talks on this stuff, $3 corn is not a problem if you can raise it for $2.50 a bushel. The trouble is we can't raise it for $2.50 a bushel. It costs a whole lot more than that. And the big factors in production costs, I like to cover and give sort of where we've been and sort of an outlook on those as we move forward. Because if it's possible to anticipate some of these increases and decreases or seasonality in these big major production factors, there's a chance to save maybe $20-30 an acre, and that is not insignificant when you look at our enterprise budgets. So I'm going to cover equipment, labor, fertilizer, interest rates, chemicals, propane, and feed. I'm not really going to go into propane. Actually, I have it on there, but it's been pretty low and seasonal for the most part. So equipment. There's been a steady increase in equipment prices. This is the USDA's equipment price index, this orange line, and a fairly linear year-over-year increase. It doesn't get a whole lot more linear than that. Just in year-over-year, we see this increase here. Now, the value, that's the blue line, is what's been purchased. Okay, so that's equipment purchases. The orange line's more on cost. And the purchases is in dollars, billions of dollars, and it's in 2011 dollars. So we've got the inflation factor covered. And look, it pretty much leveled out there after 2014. Upswings a little bit, down, but for the most part, I would call this fairly flat. And it's not coincidentally that it happened in 2014. That's the year after the big fall in corn, soybean, and other commodity prices, was 2014. So we saw this big dip in spending in equipment dollars. At the same time, equipment prices continued to rise. So that just tells you that farmers were trading off equipment less frequently, holding on to things longer. And so we just didn't see that big year-over-year spending. And obviously that has a trickle-down effect to dealers and salesmen across the state, has an impact on all that, as well as communities and jobs and so forth. So that's what's happened with equipment. I don't expect that this trend of the year-over-year increase in prices are going to change, but I do want to say something about that. And a lot of it also is the fact that when you buy a tractor or a combine today, it is not the same piece of machinery that it was back here in 2002. There's a lot more technology put into it. And all of that obviously costs money. It's kind of like cars. If you do an inflation adjusted value on cars in the 1970s versus today, you'll find that today, even though we adjust for inflation, they're considerably more expensive, but they last a whole lot longer. I mean, it used to be 75,000 miles on a pickup in the 70s was a lot. Today, it's barely broke in. You're paying, and then the safety features that they have as well. So you're not really buying the same thing. The amount of maintenance that a modern car has versus an older one, it's really not even close. So it's not really an apples to apples comparison is all I wanted to point out on that. So if we look at, this is from the Ag Barometer as well. Plans for farm machinery purchases in the upcoming year compared to a year ago. If you look at October of 20, people are saying about the same. 53% report that they're expecting about the same amount of equipment purchases compared to a year ago. If you asked back in September, it was 49. back in August 43. And then as you go earlier in the year, like this is where the pandemic was hitting, 63% was saying, yeah, or 65% in May was saying, yeah, there's going to be a lot less equipment purchase. There's going to be a lot less, which would possibly drive down equipment prices as demand was reduced, or it could even boost it in the used market if they were just looking to replace and go cheaper. But it looks like that trend has reversed. And a lot of it, again, goes back to that index, that ag producer, confidence index. Production costs, labor. So if we look at labor again has been another one of these trending up year over year. Labor costs for our producers has continued to increase across the country. And I don't expect really any reversal of this. And labor is an interesting factor in ag in the sense that ag workers, especially on the large farms that are operating $500,000 piece of equipment, it is skilled labor anymore. It is not going and finding some kid out of high school who has no experience and you throw him in the piece of equipment and he goes and drives for $9 an hour. No, that is not the case at all. And so it becomes difficult for a lot of our producers to find skilled labor and folks who are qualified to operate a lot of this machinery. We see it in the fall with trucking and folks wanting CDL drivers, and there's just kind of a shortage of them, really. So that's one of the things that's driven this increase in equipment costs as well, is we're looking to replace labor, skilled labor that we just can't find, with equipment that'll do the same thing with one operator instead of smaller equipment with 2 or 3 or whatever. And so that's kind of the trend we've had this increase in labor costs. Part of it is the fact that these workers need to be more skilled, and the other fact is it's becoming difficult to find them. Now, interest rates, that's a bright spot here on the production cost scale as far as that goes. And this is tracked by DTN across the country. Your prime rate is the red line. Large loans down around, let's call it an average of about 3.5%. And then the average bank rate closer to 3.75%. Considerably lower than it's been over the last 3 or 4 years or so. You can see that clear as day. The prime rate had crept up as the Federal Reserve increased the interest rate, the federal funds rate. You had the increase in T-bills, and that drove up interest rates. And then in the last few quarters, they've dropped rates dramatically. The federal funds rate's effectively 0, which puts the prime rate at about just over 3, which is pretty much as low as it gets. Unless you go with negative rates. So anyone taking operating loans or purchasing land on credit, which is most people who are in production ag, that's a bright spot, is that interest is really back to being almost a non-factor as far as any decision making goes. And it's been that way for a long time. I'm curious to see if someday we get back to 10%, 15%, or just 10% interest. How folks are going to react who, in my generation, just have never really had to deal with high interest rates. They've been in the mid to low single digits most of my entire adult life. And so I've never had to think, do I really want to make this purchase because the interest is eating at it at 10% or something like that. So something to think about down the road. Here's farm real estate rates. So the last one was mostly operating. If you look at real estate rates, here's the 10-year treasury is the blue line. That's down less than 1%, down to less than 1%, around 0.75%. Real estate loans getting down around 3, again, that 3.5% rate. So very low. We're not seeing them below 3 yet, but still very low. But even 2014 was the last time they were this low. And again, that was back when the Fed also had a 0% federal funds rate, or very close to it. So here's the interest rates across our district. This is surveyed by the Minneapolis Federal Reserve. If you look at operating rates, Q3 of 2018 all the way to Q2 of 20, operating loans down to on a variable rate of 4.9, fixed at 5.1, machinery at 5, and real estate at 4.8. They're lower than that now. This survey again is backward looking, so we won't get the Q3 stuff until midway through Q4, which we're in now, and we won't get Q4 into midway through Q1 of 2021. But I expect that these, when they go back and survey these, based on what we're seeing from DTN, we're going to see a lot lower rates. So when I was giving these talks back in 2018 and the first part of 2019, I was sort of talking about this increase in interest rates and what a difference a year and a half makes, we're back down to basically interest being almost a non-factor right now. Now, fertilizer. Fertilizer is something I talk about because it's such an important component of a lot of the crops we grow. Canola, wheat, corn, sunflowers, they all use, especially corn, uses a lot of fertilizer. And in the case of corn, it can be 35% of your production cost, depending on your what you do and how dense you populate and how much you lay on there. But another key fact about this is that fertilizer prices are as low as they've been in almost 10 years. Actually, I'll show it on a bigger graph here, but this is February of 2010, and here we are in 2020, and here's what you see. I mean, just really, really low fertilizer prices, and mostly we put on urea here, anhydrous being the cheapest, but it's difficult to handle and difficult to apply. Most of that's going to be applied in your eastern Nebraska and Iowa. We use a lot of urea. So again, pretty low historically, and that's a good thing for anyone thinking about planting some of these crops that use a lot of nitrogen, again, like corn, wheat, canola, sunflowers. So speaking of urea, here it is. And in November of this year, it is below the 5-year average and not quite as low as January to start the year in 2018, but fairly low and quite a bit lower than the 5-year average at about $325 a ton. So this is a good time, I think, to bring up that if anyone this is a time that farmers are able to pre-price a lot of their inputs, and when they do that, they're able to cut costs quite a bit. But so far, this area is looking pretty favorable to our producers as far as keeping costs down into the next year. MAP, another monomonium phosphate, it's trended up here recently, but the 5-year average, it's still well below that. It's not down near the low, but it's $60 a ton over, but still historically fairly low as well. And then potash is way down. It's pretty cheap to apply that right now. So several of our big fertilizer costs, potash, DAP and MAP, as well as nitrogen, fairly inexpensive right now. And that's key because that's a huge portion of the operating budget for many of the crops that we grow. Now, and then we look at fuel prices. Again, pretty low. This is the last time they were this low or around it was January of 2016. Off-road diesel prices, and this is out of Jamestown for the 5-year, about $1.39 when I pulled this, and this data runs through about the end of September. So diesel's not as big a portion of the budget as it once was, with fertilizer and other costs being a lot higher and rents, but it's still significant and it's still significantly low. Now, chemical prices, this is going to be your herbicides and pesticides. I call it flat. Increased up to about 2011 and hasn't really moved all that much. The index being 100, maybe up close to 5, 6, 7% over this 5-year horizon, but back down to where it was almost 10 years ago. So we haven't really seen a dramatic increase in the price. Now, I will say that this is the chemical price index, not the chemical cost that each farmer incurs. And if it turns out that we wind up with some big weed problems heading into 2021 or 2022 or something like that, that doesn't mean our chemical costs won't go up. It just means we're not going to have to pay any more than we've had to pay historically to actually apply those. In states that have like Palmer amaranth problems, like Nebraska, where I'm originally from, their chemical bills are extremely high, much higher than North Dakota. That is a situation we absolutely want to avoid. Seed costs, they've increased all the way through 2014 when we had the big rally, and then a very, very slow trickle downward, and they've been pretty constant. So what you're seeing here is a lot of the production costs have remained relatively flat, and those that haven't so far have actually been down, especially this year. Part of that's an impact of the pandemic. Part of that's the fact that we haven't had strong commodity prices any year in the last 4 or so to justify retailers or anyone else increasing the price. And I doubt you would find very many people willing to pay it, even if they did. And then I look at feeder cattle prices, and this is for our folks who are maybe doing some backgrounding and so forth. We had the humongous historic high prices in 2014. But fairly flat, still above where they were 2010 and 11. So when I do talks for my backgrounders, folks that are keeping calves around and trying to feed them up to 800, 850 weight, they're not going to pay a whole lot more in 2020 than they have in the last 3 years. So that makes it a lot easier for our folks to do any future planning, which bodes well for profits for anyone doing any cattle backgrounding. And then our animal feed cost index, with low commodity prices, feed prices don't tend to move either. And that's exactly what we've seen. So you see this feed cost index has remained fairly constant. So again, for our backgrounding operations, this makes planning a whole lot easier. So FAPRI out of the University of Missouri does these farm production expense projections. And these are this is kind of an amalgamation of everything. Okay. And they look at total production expenses, which is this bottom line down here. And you can see 2018, 19, 20, 21, pretty flat. I mean, from 343 billion to 346 billion over the span of 4 years. That's really not much movement at all. This year looking to be about the same as a couple of years ago. And if you look at my charts, it justifies a lot of that. Now, this doesn't have the big drop in fertilizer prices built into it so far. So this 2020 number may wind up being lower. But at the same time, it doesn't look like costs are going to have been, they really haven't been a huge problem in the sense that they've been pretty constant, or we've gotten some relief there. But with relative to the prices we saw in the years prior, they were pretty high. But now the hope is that if we can sustain some of these higher corn and soybean prices, and hopefully cattle prices and canola and everything else, we don't see costs go up with it, because that will erode a lot of the profits for our farmers across the state, which we don't want to see. So the next section, I want to talk about a little bit on land values and cash rents. This is a really important topic, and I've done entire talks, hour plus long, on land values and cash rents, and land values in particular, because that is really the biggest store of wealth for our producers, whether you're in North Dakota, Nebraska, Kansas, Iowa, is land values. You've heard the term about farmers, them being land rich and cash poor. And there's a lot of truth to it. And what it really stems from is you spend as a farmer, and I'm fourth generation farmer from Nebraska, but you spend your life acquiring land and paying for it. So making land payments and paying for it. And by the time you retire, you hope, you might have millions of dollars in value in land, but you've never made a profit of more than $50,000 a year in your entire life. And that's sort of the story for a lot of folks who are actually successful in this industry, is the fact that they acquire this asset of land their whole life, and that's what they're left with when they retire, and then they perhaps rent it out. In fact, something according to the USDA, something like 83 to 84% of all assets in agriculture is farmland, whether it's pasture land or cropland. So that's why it's such an important component. And the other part is you got to distinguish cash rents from land values, in the sense that land is a long-term investment, kind of like buying a long-term stock or something for your 401k. And when you're dealing with renting ground, a cash rent is a cash flow type decision. I'm not going to get rich paying cash rents. I'm hoping to make money if the rent's low enough on the crop that I raise off of it, because there's no guarantee you're going to be able to rent it years down the road. It's really just a 1 or 2 year thing, and then you renegotiate and you have to make all your money taking the crop off of it. On land values, you can theoretically overpay in terms of the money it generates, but you can then, if the value of the asset value goes up in the future fast enough, the fact that you overpaid relative to income isn't as big a deal. Cash rents, that's not true. If you overpay on cash rent, you're pretty much stuck with it. There's really no bailout for it. All right. So here's what average cropland value in the US has done. Starting in 2013, it is flat. Absolutely, pretty much flat. 4090 in 2013 per acre, and then 4100 in 2020. So I would call that as flat gets. There was this big increase from 2007 of 38%, but you can see most of that happened when commodity prices were high, when corn was $5, $8 a bushel, soybeans approaching $15 a bushel. Here's this big run up in land values, commodity prices crater. Land values don't go down though. They hold pretty constant. Folks weren't willing to sell at a much reduced rate, and there were enough people around with cash in their pockets to pick up anything that hit the market, at least enough to kind of keep it flat across the nation. Now, if you look in regional pockets like Nebraska, Kansas, Texas, yeah, they saw some declines. I remember reading an article one year where Iowa lost 10% of its land value in 1 year. But again, that's pretty regionalized, because there were pockets as well where cash rents were just incredibly high, and those wound up coming down as well. But things for the most part across the country have remained pretty flat. Same thing with pasture land. Yeah, a bit of an increase since 2014 of $100 an acre in 6 or 7 years for values, but not a really dramatic shift. The biggest increase coming between 2011 and 14. A lot of that was sympathy for the crop prices. There certainly wasn't this big cattle market rally for 4 years that prompted this. It was mostly just sympathetic response to cropland values were going up, so pasture land values got drug up with it a little bit. That's pretty much what happened. But again, those have been flat so far. And in some states where they especially do like fair market value on farmland, that no real increase there in property taxes or anything else. Now, here's from that Purdue Ag Barometer, and this is expectations based on their survey. About 27% expect higher farmland prices. And you can see here is the pandemic hitting, and almost nobody expected higher farmland prices for obvious reasons, because commodities were in pretty poor shape. And 35% expected lower, but we get here to this point here in the fall, and you got 27% expecting an increase, 9% expecting a decrease. You add those two together, you get 36%. That means that approximately 44% or 54%, 64% are saying no change. So they're not really going out on a limb when they say that either, because if you look back historically, again, it's been pretty flat. So the majority of respondents in this survey expecting no change in the future. I would say I personally believe the same thing, that there's really not going to be an increase into 2021 unless we have again a sustained period of higher prices. I don't see it happening into next year. So let's talk about North Dakota. Here's what land values and cash rents have done since 1990. The orange line is cash rent. The blue line is land values. And what you see, so cash rents on the right axis here, land values are on the left axis, and they're all in dollars. And pretty consistent distance between this chart, even though there are different units. But you see it gets really narrow right here. Now, why that happened was land values went up a lot faster than cash rents went up. Okay, and things have leveled off for both, but you had this period in 2012 to 2015 where land values went up really dramatically, this big steep increase, and cash rents increased, but it was a lot more gradual. So you got this narrowing of the two. In other words, so the cash rent to land value ratio in our state went down. It went down pretty remarkably, and I'll show that in a minute. And again, this comes back to partially expectations and the fact that cash rents are a cash flow decision. If you're seeing land values go up 10% per year, you're willing to overpay. And if a bunch of people come into the market and overpay for farmland being sold, that drives up values even faster, but you don't care that you overpaid because you're going to see 10% appreciation for the next few years, or at least that's the logic. And so you get this big run up in values. On the cash rent side, on the other hand, I'm not going to overpay for cash rents more than the commodity prices or the revenues I'm going to generate actually justify. So you don't see as big a run up there as you did with land values. And then both of them, once they did, they've come down slow, maybe increased a little bit in the future, but been pretty flat here across our state as well over the last 6 years. So here's what land values are, and we put this together. This comes from the Department of Trust Land survey. that they put out every year for land values and cash rents. I have a spreadsheet that puts together and does some aggregation into what we call NDSU districts for our budgetary purposes, and gives you a benchmark. Now, again, these are not perfect, because when you do a bunch of averaging, it explains everything without explaining anything. And so we've got high quality cropland lumped in with low quality stuff, but it is solid for benchmarking trends, right? Because if you assume the mix stays roughly the same year over year, at least we can say in general land prices are increasing, decreasing, or staying the same. And pretty much what you see is they're staying the same. Let's look at the this district here. East Central, 2014, 66.90 an acre, increased to 71. 2020 down to 64.40. How about in the Southeast? 2014, 96.80 for an acre for rent, then 96.50 in 2020. So I would call that no change. This data isn't good enough, and I wouldn't trust it enough to actually say it's down 30 cents an acre. That's just going to be noise. Look here at the Red River Valley rents. South Valley 124, and then 126 in 2020. North Valley 89.90, 89.70. I mean, it really doesn't get a lot flatter than that. And this is cropland rents. Now, if we look at cropland values, you've got some pockets that maybe have seen some change, but for the most parts, again, flat. Southeast 31.83, 30.50 in 2020. 2014, this area saw a decrease of about $400 an acre roughly from 2014 to 2020. Is that significant? Yes, but over that time horizon, that's a pretty small change to arrive at that. Southwest, same thing. Here in the Valley, it was 4,314, almost 4,020. And then the North Valley down a couple $100 an acre, but by and large, it's been pretty much holding steady. We've seen slight increases and decreases. And again, this is important because this is the wealth factor. This is like a homeowner and their home value, or their, the combination of their 401k and home value. That's our wealth. Those folks who aren't in farming. And so when you combine land values or have land values as 83% of their final wealth, well, the fact that they're holding steady at a time when commodity prices were down, it probably helps out a lot. Not only that, you got to remember that this also represents farmers' lines of credit, basically. This is what they have to borrow against. Since they don't have a stockpile of cash sitting around and it's all wrapped up in farmland, during lean years, this is a period of time when farmers would borrow against the equity that they actually have. So if farmland values go down, let's say 50% over 4 years, and that farmer runs into, or producer runs into a tough year and needs to borrow against his assets in order to keep operating and get by for a couple of years, well, if he cut his wealth in half, his borrowing power just gets destroyed. And it's worse than half, because if people are expecting land values to continue to decrease into the future, they're not even willing to lend on that. It's going to be a percentage that's significantly less. So this has really helped out and helped us. That, coupled with low interest rates, has really helped North Dakota, as well as farmers around the nation, get by when we had those pretty tough years, 16, 17, and 18, and 19 for that matter. Here is estimated cash rents for pasture, pretty flat as well. It's a similar story. You don't see a whole lot of movement around the state. Here in the Northeast, North Valley and South Valley, I don't have enough data. There's just not enough rented pasture land to really say anything about it. Not enough data points, but pretty flat there. Same thing with pasture land values. Here's the North Central, 730 to 796 in 2020. 2015, it was $932. In 2020, it was $1,050 in the South Central. And then here, Southeast, you saw a bit of an increase of $300 an acre. But over that period of time, that's a pretty modest increase right there as a percentage. So again, moral of the story, land values have remained pretty consistent, as have cash rents across North Dakota. So that's been good as far as from the wealth and borrowing power standpoint. Now, that cropland to value ratio that I talked about, that's important, because when you think about farmers who are either A, thinking about buying land, or B, retired and looking at generating income in the form of a cash rent, because remember, they don't have a pension and they don't have a 401k. So once you retire from farming, what you've got left, like I said, 83% of that wealth is in land. And so what cash rent you can get from the land you own is going to be your equivalent of fixed income from an annuity or something else that that folks who aren't in ag might have purchased. And right now, that rent to value ratio has been about 3% for almost 7 years. So cash rent divided by land value represents the income generation potential of the asset, and that's at 3%. And I do not deduct property taxes on this calculation. If I did, it would be closer to 2.5% or so. So not a big revenue generator the last 4 or 5 years. It's been pretty slow moving. And what this also means is if somebody was looking to expand their operation, if they were going to try to farm more acres, and this rent to value ratio is this low, it makes it awful hard to go buy farmland from a financial perspective when I can rent, when the rent to value is at 3%. A lot less risky to rent it. Then if things don't work out, you can walk away. But this representing the income generating potential of the land as far as a cash rent goes, that's basically saying that, look, renting is probably the better choice unless you just have cash laying around that you don't know what to do with relative to buying. And it's interesting. I always like to show this rent to value ratio really follows the 10-year treasury yield pretty closely. Not exact. It's not an exact match. And the 10-year treasury yield moves a lot more up and down than the rent to value ratio does, because it can. I mean, this is these things trade second by second or millisecond by millisecond. Land rents and land values don't change that fast, so this is a lot more bumpy. But still, you go back and compare the lines. 8.5% in 1990, 8.5% 1990. Come down here, we've been hanging out around 3%. And where are we at here? Ooh, clear down to 1. But for the last several years, up around that 3% mark. And that's where it's been, like I said, all the way through 2020. And a big reason for that is simple. If you can rent ground out, or if you're going to purchase farmland, let's say, or you were actually going to buy a T-bill, or if you had to purchase it and you were going to borrow the money, the interest rate becomes an important factor because they use these T-bill yields as a benchmark for interest rates charged by the bank. And if I'm only going to get a 3% return on this rent to value versus I have to pay 8%, 9% interest, well, that just doesn't make any sense. I'm going to have to get a whole lot higher rate of return on a land purchase than 3% if the interest rate I have to pay is 9%. So then I'm going to have to increase the rent, and that increases that rent to value ratio, and that's why that happens. So it's not necessarily tied to the T-bill yield, it's tied to the interest rate, which is benchmarked, and T-bill yield is also tied to the federal funds and interest rates, and that's why that moves that way. So it's something to watch when you think about that rent to value ratio, is how these interest rates move. So another component from the Purdue Ag Barometer: compared to today, what are your expectations for cash rents in your area? 82% saying about the same in October. September was about 50-50, but October, and I expect September was about 82% the same. October, 51% the same. Some are saying higher in October. I don't think it's going to go higher. I don't think you're going to see this increase in cash rent at all. It really much to speak of across the country, simply because this rally in the fall is not going to be enough unless it's sustained well into next year and folks are able to achieve much higher prices than they have in the past. I haven't heard a lot of pressure from landlords that have called me or tenants that I've talked to have cash rents increase much. Although the government program payments are helping smooth over some of those financial hiccups that we crossed before, and maybe we may see some of that in the future. So here's an interesting thing I want to talk about here on that cash rent and land value component. If you go, here's 2010 to 2019, and this is from our farm business management records, and you look at this whole chart is the number of acres farmed. The blue area is cash rented, and the light kind of teal color is area owned. And you can see this cash rented area has gotten a lot bigger. The owned acres have gotten smaller, and the total acres farmed have gotten bigger. And so what that essentially means is our producers across North Dakota are farming a lot more acres, but they own less of it. And here's something interesting as well. If you go back to 1993, the amount of owned acres really hasn't changed. It's 500 acres in 1993, and it's around 500 acres in 2019. But the difference was in 1993, the total acres farmed was closer to 1,000 acres. Fast forward to 2019, it's 2,100 acres. So instead of 50% being owned and 50% being rented, it's now more like at best 25% being owned and 75% being rented. What does that mean? It means there's less equity for the producer than there was 20, 30 years ago. So the ability to sustain and borrow against assets, sustain losses and borrow against assets has actually been reduced. So when we start bleeding money, if and when, and I hope it never happens, but if we start bleeding money like we have 30, 40 years ago, the duration that farmers are going to be able to deal with that and still have the wherewithal to continue operating, I think has been compromised. Hence a lot of these ad hoc programs that have been implemented to keep us afloat. So talking about governmental assistance here towards the end, a large share of net farm incomes in North Dakota over the last 3 years have come from these what we call ad hoc or one-off government programs. So that would be MFP1, MFP2, and then the CFAPs. These one-off, and so this is different than the Farm Bill stuff, which is a legislative bill that requires no additional action after it's been passed, that has built-in mechanisms into it that make farm program payments based on losses or commodity prices or everything else. These ad hoc ones like MFP have come through the USDA, implemented by FSA, and they do require action every time they come about, and that's the big difference. And because of those, we've been able to weather a lot of this. 2018, 2019, and 2020 is actually looking a whole lot better. So here's the USDA's projection for net farm incomes. And if you look, 2020 is actually the highest it's been since 2015. So despite a pandemic and despite a lot of the doom and gloom that was being felt across the ag community in the early part of 2020, and rightfully so, things were not looking very strong at that moment. The USDA is projecting 2020's net farm income to be considerably higher. And net farm income here way higher, basically back to 2015. Net cash farm income again, following the same trend, being close to that 2015 high and much higher than the 4 years prior, despite the MFP. So you attach the CFAP payments plus the higher prices here during harvest. And Dr. Olson will talk about the reasons for all that and cover that in detail, but just note that that's what's going on. And so 2020 is actually projecting right now to be the best year we've had in the last 5. Here's Kansas City Federal Reserve data backing some of that up. And the loan demand, this green dot here, actually expected to jump up. And you would think that loan demand is a bad sign, like the more loan demand there is, the more in trouble farmers are. And in some cases, that is just not true. It's because they're more optimistic, so they're taking on debt for new equipment purchases, okay, or new land purchases. So this loan demand actually going up is because of the optimism that we're seeing, and the loan fund availability obviously is going to go down if more loan demand, if we have higher loan demand. 10th district problem loan rates. And if you look, 2020 in the Kansas City district is the lowest for the last 4 years. So problem loans, the lowest in 2020 is what they're seeing based on their survey. And then in the classified list across the 10th district, again, 2020 being lower than years prior. So those are some key metrics there, basically showing some strength in the ag economy in 2020 heading into 2021. So what a difference a quarter or two makes, and what a difference higher commodity prices make on a lot of this outlook, and just basically the last 3 months or so, things have turned around rather dramatically and rather quickly in the overall ag economy, not just in our state, but in the region. So talking about government payments, okay, what this chart is showing, the blue bars are ad hoc programs, and 2020 is an estimate. That's where there's a little F there. And the red are like standing. That goes back to that legislative stuff I was talking about. So you see, here's 2020, the largest year for ad hoc payments since 1990. And I would go back farther and say it's the largest ad hoc year ever by far. And when you have these multi-billion-dollar, tens of billions of dollars CFAP program payments, that's exactly what's going to happen. Here's 2019 MFP2, which we thought was humongous, and it was by historical standards, much bigger than the actual standing farm programs by magnitudes. And here was 2018 MFP, which we thought was extremely big, but when you compare it to the subsequent 2 years, it's relatively minor. So I just want to show how big government program payments were. And so the estimation for 2020 is close to $37 billion in governmental assistance for farmers across the country. So the 2018, this is from our farm business management records, and I just wanted to highlight a couple of things on talking about government payments and assistance. Total government payments for the state average was $60,000 in 2018, with a net farm income of $116,000. So almost half of net farm income in 2018 came from total government payments. The low 20% quintile across the state, total government payments were actually more than net farm income. In other words, without this number would be closer to $85,000 loss. The 40 to 60% group, so the middle, let's call them average, $54,000 in government payments of an $80,000 net income. So really would have only had would have taken a loss here. And then the high 20%, about a third of their income came from government payments in 2018. So that was that smaller MFP that I showed in the chart before, the 2018 MFP, as well as the, I'll go back and show it, 2018 MFP, and then the standing farm bill stuff, quite a bit smaller there in 2018. Now, if we look at 2019, okay, total government payments for the state average was higher than net farm income. In other words, the state of North Dakota in 2019, on average, would have lost money were it not for government program payments. This would have been not just in the hole, but way in the hole. Okay, the low 20%, they still lost money, but it would have been a whole lot worse. You look at the best, the highest grossing net farmers, I should have said highest net farmers in the state, 170,000 in total government payments, more than half, or about half. And then this 40 to 60% group, total government payments for the middle was higher than total net farm income. So just illustrating exactly how important this has been for the last few years. Now, I don't have a 2020 chart because we don't have those numbers in on who got what and how much and everything else and what their overall net income was relative to government payments. But again, if you go back to this is the projection that total government payments are going to be a massive percentage of net income across North Dakota and the rest of the country. So let's talk about the projections real quick. 2020, here's the projections from FAPRI. $98.6 billion is expected to be net farm income deflated. And then 2021 is projected to be considerably lower than this year. So 2020, the highest, obviously higher than 2018, 2019, and then higher than subsequent years until we get into the 2024, 25 range. And the big reason for that is these direct government payments that I'm talking about. We go from 32.8 billion to 15.3. In other words, you cut it in half, and that pretty much explains the difference between 98.6 and 82.2. We're reluctant to say that ad hoc farm program payments will not continue because we've had 3 in a row, and actually 4 because we had 2 this year. So you don't want to say that they won't happen again, but at the same time, one-off program payments are not a guarantee, not in the same way that the legislated farm bill type programs that require no additional action until they come up for renewal, every 5 years. So those you can count on. They've happened. So folks maybe are starting to get used to them, but I definitely wouldn't be making budgetary decisions or anything else as if they're going to continue, because again, we just don't know if they will or not. So just some concluding comments and observations, I guess. Production costs and land values, they're remaining flat. That's what one of the key points I want you guys to take away. Rents don't look like they're going to move. So the wealth factor, as far as our producers go, seems to be okay, or at least I would say in the best shape it's been in the last 3 or 4 years in terms of stability, as far as that goes. Farmer optimism has improved dramatically. That's a good sign for spending. And spending within the community, spending with their equipment dealers and everything else. Obviously, that helps boost a lot of our rural communities. These one-off government program payments have been a major factor, especially 2019 and what looks like 2020. But again, I'm really reluctant to bank on those into the future. And you can see the FAPRI didn't do it either, because we have no guarantee that they'll happen again. They might not, but I certainly wouldn't be making decisions based on the fact that they will. And then the projections for 2021 are lower than 2020, but mainly because of the fact that they're just not projecting these large ad hoc program payments to be pumped into agriculture in 2021, even though they might be. So with that, I'm happy to answer any questions. I guess I got 5 minutes or so. If anyone has anything, I'm going to stop this screen sharing. Yep. Okie dokie. So I covered a lot of stuff. I know if anyone has any question at all, I'm happy to field it. Oh, good question. How much of fertilizer costs are related to energy prices? How long do you want me to spend on this? I'm just kidding. It used to be that you could benchmark the price of anhydrous ammonia to natural gas, because approximately 80 to 85% of natural gas price was baked into the price of anhydrous. And then you synthesize anhydrous down further into things like urea, UAN 28 and 32, et cetera. And so it used to be they were really coupled. And when you saw the charts for them, if you could find the fertilizer price versus natural gas, I mean, they moved almost together. That fell apart in about 2009, I want to say, because corn prices, the biggest user of nitrogen, skyrocketed, and energy prices then went kind of the other direction later after that. But they held these high anhydrous prices because they were more tied to what commodity prices were doing rather than what energy prices were doing. And then later on down the road, fertilizer has become pretty much a globally traded commodity. So what these, and I get a lot of this information because my brother is a fertilizer trader for a huge co-op down in Nebraska. I did some research with some chemical engineers on fertilizer production. That's how I know a lot of this stuff. But now that it's a globally traded commodity, what they typically do is, if energy prices are really low, and therefore fertilizer prices would be really low, or at least production costs are low in the US, they're going to ship it overseas to places where the relative cost is higher. And then at the same time, if fertilizer prices or energy price things are high in the United States, they keep it here domestically. A lot of what that's done has decoupled the price of natural gas to a big greater degree from the cost of fertilizer, because it's now a globally traded commodity. And if it's really cheap to make, and we're making a bunch of it, we just ship it overseas to countries that are going to pay more for it, and that brings that price up. So to answer your question, it used to be extremely heavily tied to it. It is still tied to it, but not nearly as much as it used to be. I don't have a coefficient or anything estimated, but I would say that it's significantly less than it was 15 years ago. Hopefully that answered your question. Let's see, anything else? I'm not seeing any questions yet so far. But I do want to say I appreciate you guys sticking this out. I know some of these topics, especially a lot of what I cover, can be kind of dry, but the importance of it going forward can't be really overstated, because that's how a lot of our producers plan. And this is sort of the financial reality that they're facing heading into the next year. A lot of uncertainty. We just had an election. Things may or may not change that much. We just don't know. But it's something we've been dealing with now for the last 3 years, is high levels of uncertainty. So I would say that we're ready for it, and we in Extension are here as a resource to try our best to answer any questions that anyone listening has on anything. And if we don't know the answer, we'll try to find or direct it to the person who does.